Alrighty, I have pressed start, just waiting for Reese to come in. So while we are just waiting for all the attendees to jump in, I will just go through what I normally do for each session is just to remind those that are listening live or to the replay today that the purpose of these monthly insight catch-ups are so that we can provide our investors with a better insight of what's currently happening in the market. And so when we do get clients that, hey, Reese, I've just jumped straight into it. So because we're on a tight time frame today. The insights that Reese shares with us each month for the Perth market and for the Melbourne market are to allow us to have those better conversations with investors so that when investors contact us, they ask, should I sell the property or not? We have a little bit more idea of what is happening in the market and what they should do. Now, I know that the people jumping on today watching might only be interested in the Perth market, but Reese and I have also got one for the Melbourne market straight after. And I do recommend that property managers, regardless of where you are, you do actually pay attention to both markets from the pure reason that our investors that we've got at the moment, they do tend to have properties in multiple areas. So for example, if I'm in WA and I have a client call up and say to me, oh, I'm thinking of selling, I've also got a property in Melbourne, at least you've got a bit of insight of what's happening with their other properties as well. And then you can refer them, to these webinars or you can refer them to Reese. Another advantage as well, just recently, is that I have had a lot of property investors that are looking at getting into the market in Perth. And yes, there's a lot of us watching today where we do help those clients a lot. But they're also getting quite stuck with being able to find something and have gone, you know what, maybe I do need to, get a buyer's agent. And so what I do is I always refer them to this training, and then I would refer them to Reese and say, listen, if you do need someone, call Reese. So that would be a benefit as well. Now, Reese, I'll get you to unmute and I'll get you straight into it. I only started recording straight away because my diary today is like on the half hour, and I'm just like having to be so efficient because I'm so worried that if I am late 10 minutes, it's going to put everything back for the rest of the day. So that's why I'm doing that. But I will hand it over to you and hear what's been happening in the last month.
No stress, no stress. Yeah, let me just get my screen up. But yeah, happy to crack on. So, 2 seconds. Ash, just let me know this is coming up. My slide deck. Is that working? Okay. Yeah, so sorry about that. Some technical issues. Perth property market. Not sure how closely everyone on this call has kind of been following.
Sorry, Reese, just make it bigger for me. Sorry.
Yeah, easy.
That's it.
Now?
Yeah, that's better.
It's hard because I'm on a laptop, so I can't actually see you. I can only see my screen. So all good. So yeah, I mean, look, started the year strong. I think if you looked at the back and those that joined on the January update, we really gained a lot of momentum, not just in Perth, but across the country, the back end of last year, especially from the government stimulus with the first home buyers increasing the no LMI cap up to 850,000. And what we really saw is those affordability price points, anything under sub 850 is just driving, and that's where a lot of the activity is. And speaking with the team members here within the business, the buyers agents, there's 60, 70 people at these home opens on that competing stock. So it's super competitive in that price point, and that's why you've seen serious amount of growth over the last 3 months. So if I'm just looking at from October when the changes came in, we did 2.7% in October, 2.9% in November, 2% in December for typically a soft month to do 2% in December, and then we started the year with another 2%. So just gone like crazy. Even in the last 6 months, you're looking at over 6% growth. So the market is well and truly hot at the moment. The listings is probably a similar message that I would have said last month, where we're still hovering below that 3,000 active listings, which, just to give you some context, like a balanced market between sort of 12 and 13,000. So we're significantly off where we need to be from a balanced market. So what's generally happening? No stock on the market. People are trying to get into the market. People are trying to access this incentives, whether it's that first home owner scheme. People are trying to get in before potential interest rate increases, and that was, with moving into February off the back of the RBA announcement yesterday, the increase. I think that will fuel a lot of activity in the next couple of weeks as well. So, yeah, the market is well and truly hot. I think what we're finding at the moment is even stock on the market that in a relatively warm market shouldn't sell is selling really quickly. So, yeah, from a
I was just going to share a couple of stories with that, Lan, because one of ours was on the market from $7.99. It was actually one of our team members from $7.99, and it sold 120,000 over market. So in the last 5 years that she's had that property, it actually has tripled in value, and it's ridiculous. I mean, she is just completely elated. Sold to a first home buyer. But the property sold, I think, for early 900s for a first home buyer seems really ridiculous. So that one went over a lot. She said, I think there was about 50 people through that home open, and that was in like Clarkson area. What actually there was two things that I just wanted to quickly ask you, and if you can bring it into the conversation. One was that I am seeing investors coming back into the previous hot markets like Port Kennedy at the moment, which I find interesting that they're coming back when there's already been such growth, where there's other areas that maybe haven't had, like still had high growth, but not as much. So I just wanted if you can touch into that as we go along. And the second thing was I have found that, like, I had a client the other day who messaged me and said, oh, there's a property in Secret Harbour that he wants to buy for his client. And it was, I think, going to go, it might have been on for 860, and he was going to have to offer over and above. And he wanted some guidance on that. And I mean, generally as property managers, we would work with what the rental yield would be. But I'm also finding myself having those conversations of, well, listen, it really comes into what you believe is going to happen in the market. If you believe that the market is going to move another 10% this year, then if you were to pay 5 or 7% more than what you wanted to, would you recover that back in less than 12 months? And would you not be as bothered? Because you will get that money back, but it just might take 12 months. Like, that's sort of like where I'm stuck having those conversations. Like, what are your thoughts around that?
Yeah, great questions. And, both those locations you mentioned, Port Kennedy and Secret Harbour, relatively similar proximity to where a lot of sentiment's driving new investment activity at the moment. So that AUKUS program, you're probably hearing everyone talking about it at the moment, is really going to be, from a economy perspective for Western Australia, it's a massive driver. You think about WA and Perth particularly as really reliant on the mining industry from an economy standpoint and job creation standpoint. Now we've got this AUKUS program, which is in Henderson, which will bring in over 3,000 jobs. Crazy amount of money invested into that, and they're all going to need places to live, right? And the reason some of those areas are getting a bit of a second run is those are all in close proximity to where the AUKUS program is going to be. And that's a really fascinating point, right? So I think I mentioned on maybe last month's update that the main key drivers, right, for price growth is going to be demand versus supply. But there are a couple other factors that don't come in from a demand. Well, it helps fuel the demand, I should say. But when you're looking at demand, you're looking at population growth, right? Is there enough houses? And Perth's got the highest population growth in the country at the moment, right? And we're not building enough houses. So there's always going to be a high demand, but there's more people in there and less supply. But one of the key factors that a lot of people don't take into account is sentiment. And you've seen sentiment in COVID. You've seen sentiment now in Perth in this particular area where, although the AUKUS program hasn't kick-started and those 3,000 employees haven't moved or migrated to Perth to start working on these submarines or the marine activity they're going to be doing, people are now starting to speculate and say, well, because there's these 3,000 people coming, 3,000 jobs going to be get created in this area. People are going to want a nice place to live close by. They're not going to want to have to go into Perth. So Rockingham, I think you mentioned there Secret Harbour and Port Kennedy, Ash, but an area like Rockingham, we get a lot of inquiries about Rockingham, which was an area we bought in 3 years ago at the start of its run. So those particular areas are going on an additional run, and it's because market dynamics have changed. It's because sentiment's really driven that. So that's kind of my thought process and why those areas are now starting to become popular. For me, though, if you are looking at those areas, the assets we bought in those areas 3 years ago will look completely different to maybe if you wanted to get in that area now from an asset selection perspective. So just to give you an example, obviously, houses have gone on a serious run there or since sort of 2020, 2021. Yes, you could get in the market and Ash, you probably would get 10% growth in the next 12 months. But if you're paying 10% overs, you're really not leaving much more runway to go. If the area's already gone up 70, 80% and you're paying 10% over, you're nearly getting in. You are getting in the back end of the cycle. And you can see from this slide here, this is the cycle we're on. And this is a really powerful, in terms of people always ask how long is Perth got to go on the runway, right? You look here, where we started from a last Perth market always has like long periods of stagnation with sharp increases. So you look when we started, say in early 2000s, median house price, let's call it 150. It then peaked at about 450. So it tripled in value during its cycle. Then for 10, 12 years, stagnation. Now our starting point in the cycle was about 450. And we're now, depending on where you look, there's articles out a couple of weeks ago saying, depending on the data warehouse, Perth median house price is $1 million. Some of the data we track, it's probably more like 950. But you look at that, we've gone from 450 to 950. So from a historical standpoint, the market tripled in value in its last cycle. And 450 to say, let's call it 900 to 950, it's doubled. So we've doubled in value since the start of the cycle. So just from a historical standpoint, I think it's always important to look at a longer term period to understand trends. From a historical standpoint, Perth has shown that it can go like from a growth cycle, it still has room to go. And then when you take that into account, you probably saw me mention this on the previous month's one. This is the affordability index, which that is your median household income. How much of that percentage is used on the median mortgage repayment? You look back here at the last peak, we kind of tapped out at 49% of the household income was used on the mortgage. We're only sitting, I think the latest data is about 39%. So we've still got, from an affordability standpoint, looking at the previous cycle, there's still headrooms to go from an affordability standpoint. So from an investor, you're looking at this graph here, there's still, clearly showing there's still room from an affordability standpoint. You're looking at the price growth on houses and units, you can clearly see we're on an upward trajectory and a very aggressive one. And we've done that same trajectory before. The challenge you want to have is, I guess, what you've really got to weigh up as an investor is, ideally, you don't want to be getting it on the start of the cycle because, if you're a genius and you can read the markets well, you'd rather get in, too early than too late. So, ideally, you'd want to enter the market around 2020. But even if you entered around 22, 23, 24, you still got, a lot more to go. I think the challenge you have now is where you're entering in the cycle. So if you are entering towards the back end of the cycle, you're going to have a limited runway in terms of what property growth is going to have. So what we are saying to our investors, so just to give some context for everyone on the call, last month, a third of our deals, or a third of our settlements were in Perth. So we are still buying in Perth. We do see some value. We are very much a strategy and advice-based business. So the strategy for anyone entering Perth is if they're after quick capital growth, because you can see what the market's doing. I mentioned earlier we've done 8% in the last 3 months alone, last 4 months alone, I should say. You are going to have that quick capital growth. Perth will be north of 10% this year, closer to 15. But how much further can you go? So that's the challenge we're saying to our investors. If you are wanting to enter the Perth market, Perth will outperform any capital city this year, but how much has it got to go? And the interesting one is when I go to this affordability index again, if you think about affordability index, when prices go, that gets higher. So when prices get higher, that gets higher because your mortgage payment gets higher. But if interest rates go up, that also gets higher. So everyone would have seen the news yesterday, the cash rate has increased by 0.25%. So even if prices didn't move anywhere, this would still go up because people's mortgage repayments has gone up. So cash rates or increase in cash rates, which depending on which economist you listen to, we predict there's going to be a minimum of 2 this year, 2 increases. That will also start to close the gap. So for me, Perth is definitely a really good option. You really want to look at the micro fundamentals now. Like I think where you probably could have thrown the dartboard and bought anywhere in Perth over the last 4 years, if you're going to make north of 30-40%, I think those days have gone. I think it's now finding the right micro dubs, the right suburbs to invest in that are going to have a longer runway. So the reason you're probably actually getting a lot of activity around that, that Secret Harbour, Port Kennedy, Rockingham, is because that sentiment from the AUKUS program and from an affordability play, you can still pick up some houses with a decent land component, potentially some development opportunity for around the 850, so below the median house price. So markets like that, I think where we probably see a lot of activity from an investment standpoint is going to be more that affordability play. So anything in the lower market, we can get a bit of a land component, land value, particularly that south region, like we just mentioned, that does present itself for a lot of value in 2026. I can't see my screen, but any questions on that? I've seen something in the chat.
No, that's all good. Yeah, so I guess so you sort of said that if they do overpay potentially 10%, then they don't have that runway. So therefore they would really be needing to hold on to the property for a longer time, and they would have to sort of rely on that affordability and the cash flow side of things. That would be the benefit of that investment property, more so than that big sort of capital growth, which we know they're not going to get that big capital growth again. But the numbers still have to financially work out for them, because we are struggling a lot with investors financially being able to afford rental properties at the moment. And I had one yesterday where he's got a tenant who hasn't paid rent, and he's like, it's going to be really hard for cash flow. So because these investors have all got these multiple properties and done well, I don't know whether people are having, and I mean, I blanketing all buyers agents, but I don't know whether you guys are all having proper discussions with them about, have you got money to afford the rental property? Like you might have your deposit, but do you, if your tenant doesn't pay rent, are you okay? If you've got a big maintenance bill, are you okay? Do you have, a buffer of 6 months? I feel like that needs to be taught a little bit more to these investors, because, the people that are on listening today, I'm sure that they've had a similar experience that, getting maintenance done, like I guess investors just aren't prepared for the expenses that come with it.
Yeah, and I think that's a great shout. So with us as a business, not everyone's strategy is going to be the same, right? Like we could have 5 investors come to us with an $850,000 budget, and all five could get recommended a different asset type, a different location, because it's really going to depend on what the overall objective is. So Perth, for example, at the moment, although the fundamentals are the strongest in the country, but obviously the graphs I showed you earlier, we're trending up. There still is growth there, but you have to be pretty bold to pick when the top of the cycle is. It could go beyond that. Who knows? We could get a historical peaks, but just looking at historical data, you would say if you're buying in Perth at the moment, there's probably two people that would be buying in Perth. One, someone who's wanting quick capital growth so they can leverage that equity to buy another property and put that in another market. And if you are doing that option, our recommendation would be looking at a blue chip asset that you can hold into the next cycle. So you saw, and having held, and I'm sure you probably have as well, Ash, but held properties through the stagnation period in Perth, it can get pretty quickly there in terms of when rents start dropping and your cash flow, and that's why it is important. We always have a minimum 10% cash buffer with our landlords. You want to be getting, a nice asset where you can leverage some equity now. So, maybe you'll do 25-30% growth in this cycle. And then if it, like Perth's historically done, there's going to be some stagnation when the market tops out, whether that's in 2 or 3 years' time. You want a good quality asset that you can then hold for the next cycle, and then hold that for another. But that really depends on your journey, right? Someone like me, 35, I could happily hold it for another cycle because I'm not going to be retiring in the next 10 years. But then then what I could do is have the value in the next 3 years, capitalize on some of that equity and maybe buy another property, or capitalize on that equity, just have a bit of a buffer there from an equity play perspective, and maybe it improves the yield. Hold that from a stagnation period, and then when the market goes again, maybe that's when I look to cash out once we're sort of gone through 2 or 3 years of the next growth cycle. So that would be getting this late in the cycle for us. It would definitely be trying to get a good quality asset that you can hold. Because otherwise it's going to be, or it's a speculative asset, right? If you're looking to get in the market to sell out at the top of the cycle in who knows, 2 years' time, if there's a shed load of interest rate increases, it could be even less, could be 3 years' time. You really want to make sure you've got a decent amount of growth that covers your buying costs and your exit costs at the end of the day. So, from us, a lot of the investors we deal with, we want to do, long-term relationships rather than a sort of a trade-in, trade-out strategy. I'll just show you one thing actually before we wrap up. I think I've shown this on a graph before. Now I'll zoom in a bit because I think this is a little bit far out. So what this is, right, is this is our affordability run rate. So this is what we track with our PropStack data. I can't see you, Ash, but can you let me know if this is up?
Yep, I can see it. Yep.
Cool. Okay, so let's look. Let me just quickly. I think Macquarie, from memory, their interest rate from an investor was 5.34%. So what this is showing me in terms of historical data, so looking at median salaries and what we've previously seen in cycles, Perth's ceiling on current interest rates would be at 1.33 million. So if you, like I was mentioning earlier, depending on which data warehouses you look at, we're floating between 950 and 1 million as a median house price now. So that gets you, and you can see there where it says 49.3%, 7%. That affordability graph I showed earlier, once we get to 49.3% of the median salary, that'll cap out at 1.33. So still a lot of runway to go in the market, right? Now, so you can see that's at 1.33. Let's say, well, now that was what the interest rates were of yesterday. Let's say it's now at 5.6. Now it caps out at 1.27 million. So not only can wage prices affect where we cap out, but actually interest rates can as well. So obviously the higher the mortgage payment, less affordability you got, the tighter it has to have a bit of a squeeze. What you see in markets like Sydney and Melbourne, these rate increases really impact them significantly compared to an area like Perth. But if we do start to get another few, so typically they'll go up 0.25%, depending on, maybe there's some crazy inflation data where they want to rein it back even more. But let's say it goes to more, we have 6% interest rates at the end of the year, caps out at 1.18. So interest rates, will have a large bearing on where, the ceiling can go. Perth has historically benefited in the past with highest median salaries in the country, where when interest rates have risen, hasn't really affected the overall growth. But as we now start to get towards that topper echelon of property prices and median prices, interest rates will start to take effect. So it'll be interesting to monitor when we come back next month to see how Perth perform. Putting my name on the line here, I would say there'd be no slowing down. If anything, people would be wanting to get in quick now, with the sentiment maybe that the rates will go up even further in the coming RBA announcements. So yeah, for me, I think we'll probably see another solid month in February. But once we get that second rate increase, it might start to put a bit of pressure on price growth.
Can you just, and if anyone's got any questions, pop them in. That chat should allow for everyone to reply. If not, I think just raise your hand or do something and it'll notify me. So when you've got, can you just further explain that ceiling? Is that ceiling you're referring to? Do you mean that's when that gets to the average the average price for houses?
Yes. So the way we work our ceiling out, and there's a lot of assumptions made in here. So how you get this data is you look at census data from 2021, right? So obviously there's going to have to be some assumptions of what's changed in 2021. You look at inflation data and see what salaries would have changed to. You look at what the cash rate was then to see what their mortgage repayment was versus what it is now. So there's a few assumptions in the background. A lot of it goes over my head. We have an economist that helps us out in these indexes as well. Now, what I've shown you there is that slide that I kept showing on the affordability index. That was where it's saying 49% of the combined household income was going on the mortgage. Now, because we're currently at about 38% or 39%. So there's, from a historical ceiling, we've spent 10% more on our mortgage. But what does that 10% look like when you're looking at your average salary versus the mortgage payment? What does that 10% look like? And that's what that graph I was just showing you there looks like, where it's kind of bringing it to life, where, we're at 39% of our combined salaries going on a median house price of $950 $1 million. But if we went to 49, what was the peak? What is that from a price point perspective? And that's where it came out at, no rate cut, 1.33 mil. Then as we started to see rates stay the same, 1.3 mil. But as we started to see rates coming down, that was dropping down to 1.2, 1.1. So that was probably just trying to highlight the fact of, rate increases once we now starting to get closer to our ceiling, so historical. And that's all, at the end of the day, when you're looking at trends, you've got to look at 30, 40-year history on some of these things, and that's just where we've seen before. But to give everyone context on this call, besides Perth and Melbourne, every other capital city is past their peak from an affordability standpoint and a price perspective. Perth obviously had a big mining boom back in 07, so that's why we're at 49. Melbourne obviously has had that long period of stagnation post-COVID, so it hasn't got back to its historical level. But just in context, we are very much at a concerning level of debt across the country, with everyone kind of going through this like winner's curse phase at the moment. So for us, I think Perth still has the strongest fundamentals though. So if you're looking, and we do get a lot of investors that just want to invest in Perth, want to invest in outside their background. The fundamentals are still really good. Bearing in mind where we are in the cycle, it's really important to get the right asset, and you don't get a compromised asset that does well during the peaks, but once we start to level out, the cracks will start to appear. So just to give some context, what would be a compromised asset? Off the plan apartment, something where there's maybe the outer house and land package areas where the infrastructure isn't there and there's an inundated of investors. When a market cools, those areas will take a hit. Get good, strong fundamentals where the owner occupiers want to be, and a blue chip area, you'll be able to ride through any stagnation period. And actually, those prices will still go up.
With such great growth and being at a peak, I'm actually surprised that I don't have more investors wanting to take advantage and sell. Like, they obviously do have a long-term plan and goal, which I respect, and obviously I love that they hold on to it. But it's interesting that more people aren't taking advantage of selling in the market, but time will tell.
It's a hard one, hey, because you look at that and you're like, well, it could still. And then when we're speaking with our clients, we just monitor it. We'll say, look, let's just keep tracking the data. You don't want to go too early, but you don't want to go too late either. So, and that's why asset type and strategy is really important, because if their strategy is, to retire in 20 years. Well, actually, it's a good asset. Let's keep it till the
Mm.
next cycle, and let's just leverage some of the equity you've made. Maybe you've made 300-400K. Let's take some of that equity and buy another property in a market that's maybe on a more the start of their journey.
And we're all great property managers that look after them, which makes them want to hold on to their property longer.
Exactly,
Maybe it's all about us.
100%.
And the people I
Exactly.
can see on the call today are definitely the top property managers in WA for sure. So and that's actually a really clear sign. The people that are on here, they are invested into what's happening in the market so they can better service their client, and it shows because yeah, they're doing the right thing and understanding everything. And I thank all you lovely people for being here. So Reese and I are going to jump off because we're going to quickly go to a Melbourne one. I won't have time to get you guys on the Melbourne one if you haven't registered, but I will. But do just message me if you do want me to put you on for next month, because I think that it would be good to hear what's happening. Or actually, you can probably just watch the replay for Melbourne because your clients most likely may be living in Melbourne or have property there as well. So I think it's really great to have that understanding. So we'll move over to the next one, Reese, and I'll speak to everyone later, and I'll see you in a minute.
Well, thanks everybody.
Bye.